Good afternoon, and yeah, we're that panel, the one that keeps you from the actual fun stuff. So thank you to all of you for still being here. We appreciate you very much. I think it's going to be worth it, though. This is going to be an interesting one because we have here a very different selection, a very diverse selection of fund managers with different investment angles and structures. And I think it will be very interesting to know how these different ways of investing or accessing this market have their pros and cons, and I'm sure that you'll benefit from that. Just very quickly, I mean, everyone was introduced here, but I would love all the panelists to quickly explain what their firm does before we get into the meaty stuff.
Hi everyone, thank you very much, Jorge. I'm Kevin Ballard, I'm the co-founder of Block Asset Management. We are a Luxembourg-based AIFM that specializes in the digital asset class, of course. We launched the world's first digital assets-focused fund of funds back in 2017.
Hi everyone, my name is Anatoly. I'm co-founder and CEO of Nickel Digital. We are a London-based multi-strat quant fund running multi-PM operations, which is a market-neutral structure. Tapping into talent across the world with 36 quant teams under one umbrella.
Hi, good afternoon. Thank you very much for staying with us. I know that a lot of people are having drinks out there, so really appreciate you being here. My name is Ariel Navarro. I'm the co-founder and CEO of Well Capital. We are a long-only fund based in Madrid, and we've been running for 2.5 years.
Hi everyone, I'm David Chreng. I'm one of the founders of LeadBlock Partners and LeadBlock Bitpanda Ventures, which is the latest VC fund that we launched in partnership with Bitpanda, the European broker.
Amazing. And I'm Jorge Schnura. I manage Turing Capital, which is a Luxembourg-based GP with a couple of funds, quantitative funds, a long bias fund and a market neutral fund. And I would love to hear from everyone here what you guys see as kind of like the pros of the different structures and strategies that you follow, right? So if I'm a family office or a high net worth individual willing to allocate into crypto, I don't want to do it direct, I want to do it through a fund, why is a fund of funds a great option? Why is a multi-strat quant fund a great option, right? So what are the pros of each of these different angles of getting into crypto, and also how they're complementary to each other, right?
Can I suggest that I go last?
Sure.
For obvious reasons.
Yeah. Who wants to be first? I can start.
So I think the way we think about this is really, people that are in the strategy and we're investing in strategy. You have two different kind of people. People are thinking, well, blockchain is the next best thing, and it's going to take, it's an Asian technology, and it has the capabilities to all the potential to grow exponentially, right? And there's people like ourselves, long-only funds, the long bias fund, and even yourself on the venture capital. And then you have people that they say, right, I don't know about blockchain, I don't know what is going to be the next big technology, and they probably, but what they see is there's inefficiencies here, and there's a market, it's a real market, and we can actually perform different strategies. And I guess Anatoly, your fund is, or your managers are one of them. We are sitting in the former one, which is we believe in blockchain. We believe that this is a technology that is here to stay. It's as you guys know, it started in 2014, but it's been growing, right? And the way we see this, and I think in the previous panel, Felix made the distinction between what is Bitcoin, which is an asset class, it's a proof of asset class already by itself, and then you have all the rest of altcoins, which is how we call them, right? And the way we look at them is real, like liquid venture capitals, right? Now, when we started the fund, one of the things I would say is we would look at, most of us in the fund are from traditional finance, and what we thought is, okay, how can you actually have a portfolio that is well diversified and effectively diversified, right? And what we did was basically a combination of quantitative strategies and fundamentals. So we basically, on the one hand, we use statistical methods to find this true diversification, and then we do a fundamental layer to pick or cherry pick those funds. What are to your question, Jorge, what are the advantages of that? I think what we're capturing here is this, again, and it comes back, and I'm sure my fellow panelists, that they're probably going to talk about this too. It really comes to your risk appetite, right? And the volatility that you're able to digest. We are very upfront with our investment. We say, this is a fund that will perform better than Bitcoin over a cycle, which for us is around 4 years. And that's where we're at.
When we launched the fund 5 years ago, our thought process was you can either go as an investor in a directional fashion to capture market expansion, or you can go in market neutral. We went market neutral on the assumption that not everyone can underwrite volatility of 60% as an investor. If you, on the other hand, can lower vol to single digits, it fits many portfolios. And for example, we run fund today at 5% vol, which is 1/10 of the underlying crypto market. Now, the next question mark is like, how do you approach this? Because everyone talks here about diversification, and that's a critical factor. You can either go as a fund of funds, you achieve diversification, but you lose one thing, which from my perspective is critical, risk control. And I think fund of funds have to justify as to how do you outsource investment decisions to underlying funds, but you don't have second-by-second control over your capital. At best, you can redeem in a month or a quarter if you are unsatisfied with the underlying performance. We went the path of multi-PM structure, whereby we control capital at every single moment of time. Fundamentally, we can see what happens in the portfolio on a field-by-field basis. And we can cut the risk at any time versus a strictly agreed risk framework, such as max drawdown, max beta, leverage, gross, net, which is systematically controlled on our end. And I believe what we're achieving here, we're still getting the diversification. However, we never release or relinquish the control over the capital, which, again, from my perspective, is a critical component.
I mean, on our side, I mean, most of the panelists here are talking on the trading side. We're looking at it from a long-term fundamental standpoint. So I know there's not a lot of long-onlys right now that are in the market, fully liquid and so on. But on the VC side, on the pros, we get to build the relationship with the founders relatively early on, and some of them manage to become very successful of the like of layer 1, layer 2, certain dApps, and some of us don't. But the particularity of this space is within the span of 2 to 3 years, the founders need to find an idea, find a co-founder, a full team, hire them, raise capital, structure the market-making deal, get the listing venue, list their token, and make sure that it doesn't do a pump and dump. That's a lot to take on, and I don't think that a lot of VCs are necessarily prepared for that. The previous cycle was a lot easier because it was partly fundamentally driven with the team, the product market fit, everything that is very similar to a traditional VC. But the rest was an arbitrage as well. If you knew that you were investing, let's say, at 10 cents, and it was going to be listed at $1, traditional VC don't get the liquidity as fast as this. But a VC is typically advising and supporting the founders under the radar for a long period of time. And usually when they tend to sell, it also sends an indication or signal to the market. But here you have a dilemma where you do a 50x or 100x, you still like the founders, you still want their success, but after 3 years, that's an insane amount of return that you need to secure. What do? Do you just sell everything and dump it, regardless of the consequences? Or do you do it gradually, take a risk on your return for your LPs, but maintain the long-term sustainability of the project and so on? So those are the dynamics that I think are very important to consider as we move into a more institutional-driven market, where you have private capital coming in, where you have public capital, but not only short-term or trading strategies, but you also have long-only, fundamentally driven type of strategies, which I think are going to come in the coming years.
Thank you. Well, fund of funds viewpoint is as it says on the tin. I think we all understand the basis and the logics behind a fund of fund and the players. And Anatoly mentioned the diversification that a fund of funds offers. I think everybody's seen today the array of talent and managers that have been up on stage and the various strategies that exist within. We took the approach that, and our team come from the traditional world, from Credit Suisse, from Julius Baer, from SocGen, that the digital asset class, our network that we'd spoken to in our early days, they wanted exposure to the digital asset class, but they clearly didn't understand the asset class, and they wanted a diversified approach. So we set out to do just that, and to provide the approach that there are a lot of managers out there, fantastic managers, and three of such are sat here. There are also a lot of managers, I think one of the previous talks mentioned, there's also still a lot of bad players in the space, and it's getting better, but due diligence is so important that that's what we set out to do. We set out on the fund of funds approach to say, can we be an institutional grade risk filter to this asset class? So can we look at the funds out there, and our proprietary database now is around 1,200, 1,300 funds. So obviously many of which are here today. And basically whittle them down and carry out the due diligence to find the best-in-class managers and allocate across the array of strategies that have been mentioned, whether that be better passive, directional, market neutral, venture capital, and therefore be able to allocate to the best-in-class, but also use our weighting on a monthly basis, say, okay, how is the market looking? Do we want to be more heavily directional, as we are at the moment? There'll be times towards the end of the year, and there have been years gone by when we've been much more cautious and we've been much more market neutral. So, we're not tied to one strategy. It is diversification. There is a cost, of course, for diversification. It doesn't come free. But the research and the due diligence that's required to spot the bad players in the space, to make sure you're allocating to the best-in-class managers, I think is worth that extra cost. So, yeah, there's fantastic funds out there. And as I said, the guys here are all on a white list. I'm proud to say, one of which we're currently investing in. One is at the latter stages of due diligence, and the other will be pumped up the list as I get back from away, but I won't say which one's which. But yeah, it just gives that diversification.
That's great. So there's a few, I think, interesting topics that you guys have touched on. One of the questions that I think many people always have is, especially when we're talking about neutral strategies that rely on arbitrage, is liquidity, right? And how is capacity in terms of liquidity of a strategy managed, in terms of how you use diversification to increase that capacity, and also how you see the liquidity limitations evolving in this space in terms of volume and spreads for those arbitrages and so on. I think that's something maybe interesting if you maybe want to discuss that point.
Interesting on the spreads. When we started business 5 years ago, I heard a number of pushbacks saying like, are you sure this arbitrage gonna last for long? And I thought like, actually maybe longer than you think, given the structure of this market, its fragmentation and multiple liquidity pools. This ARB is structurally present in the crypto space. And as a matter of fact, out of 5 years of our existence, last year, 2024, happened to be the most profitable in our history, which is in a kind of very counterintuitive. There wasn't a compression of spreads. As a matter of fact, diversity of instruments and much deeper liquidity pools allowed to extract this alpha from the market without increasing the risk. Risk, as a matter of fact, has fallen over the years, surprisingly. So this is a critical consideration. There is also kind of liquidity constraints. Realistically, for the true market neutral strategies, you're going to bump at some stage into maximum capacity. And we can see it across our underlying managers. When they come to us, the initial expectations from their side can be, we can manage 30, 40 million bucks. And then as you keep scaling them, at some stage you may bump that actually the capacity is not 40 as they thought. Capacity happened to be 15 or 20, which is perfectly fine from our perspective. We're gonna kind of optimize for the return and Sharp rather than just kind of pushing capital at these managers. But ultimately you arrive at the fund itself, even with having this 36 underlying managers, diversification has the capacity limitation. As a matter of fact, we had to soft close the fund as of yesterday or the February the 1st, because at some stage we believe it's worth kind of kind of pausing, accepting new capital, make sure you can still deliver these returns on the significant increased asset base before reopening and taking new capital. And I think for the market neutral funds, this is the path forward. Instead of being asset governor, you have to optimize for the returns for your existing investors.
Yeah, I think there's also something added to that probably, which is even though blockchains are very public and you have a lot more information readily available than you have in other sorts of markets, the asymmetry of information is actually higher than in traditional capital markets, which also creates those arbitrages. Because at the end of the day, when you have a lot of information and you have retail access that's easily available, they're not able to digest all of that amount of data. So there's more data, but it requires more sophistication in it being interpreted, right? And that creates bigger asymmetry, which is counterintuitive to the idea of the data being publicly available, right? And that creates also bigger opportunities in that sense. Again, taking into account that there's a lot of retail money in this market, right? You know, Ariel and Kevin, I think one thing that's maybe interesting that I think has changed a bit the approach of funds to the market, and especially to the value that they show to LPs, is the existence of. I mean, we've had ETPs in Europe for a long time, right? But now with kind of like with the US ETFs, even the European ETPs have become a bit more notorious, right? And investors are more aware of them, right? And now they have ways to easily access Bitcoin, right? And so, how has your kind of like approach to, you know, the value you add to investors changed based on that?
It's at the end of the day.
Or maybe not changed. Maybe it was always there, right? But,
I guess it has been there. But you see now the different options that are available, and with the readiness of, obviously you mentioned rightly, in Europe we've had for some time, but in the US, the ETFs, we have a lot of our client base from Latin America. And obviously the launch of the Bitcoin and Ethereum ETFs means that they now have this viable, simple option to buy. The problem that they have is they don't know when to get out, and they don't know when to sell. So if events are happening in the markets or cycles are coming to an end, are they buying at the wrong time in the cycle? You know, they need to use a manager that will give them that scope to say, okay, we're now, as I mentioned before, it's a time to be, you know, less directional. It's a time to take a more protective stance, and let's have a look at where we are in a cycle or in the market. So adding value there is to knowing what strategies to be in at what time in the market. I mean, it's tough to time the market, and nobody really, I think, gets that right. But I'm sure, like many of you, I was up early this morning trading and trading personally cryptos because of what had happened in the market and the overreactions we always have in the market. So, you know, if you use a manager, and I'm sure the guys will back me up on this, you're paying for that expert ability that the guys will say, okay, we're not going to panic in market conditions. We're not going to get caught on the wrong side of a reaction, the emotional side that retail investors have. And whilst institutional money shouldn't fall for that kind of thing, we do see a lot of our network that, you know, have in the past gone directly into trackers. They've come out at the wrong time. They've gone into certain offerings, and then they've jumped out with fear, and the market has rebounded in no time whatsoever. So I think you need a manager, and the diversification is a simple strategy, but you have to be with a manager, whether it's a diversified approach through someone like Block Asset Management, whether it's through any of the strategies that the experts here can give. It's adding that value add, because we know this industry is very close-knit community. It's an industry where everybody kind of knows what's going on and kind of knows each other. And having your ear to the ground in this asset class is vital. That knowledge of having your ear to the ground, because the network that we have and the guys that we speak to is fantastic. The monthly calls with the managers, you know exactly what's going on in the asset class. For investors that are thinking, okay, we'll do this on our own, we'll just go ahead and allocate to an ETP or to an ETF, are you confident that you're going to do so, and you're going to know what event is a time to get out, or what event is just a blip and you should actually be adding to your allocation? And at what time do you need to really make a defensive approach in the market? So even the pros get that wrong. You know, a lot of managers, 2022, we ourselves, people get caught. You didn't get out quick enough, and we couldn't move quick enough. For retail investors, or for even institutional investors that are making their own decision, they're just going to buy the ETFs, well, you know, make sure you've got your ear to the ground so you know when to get out and when not to get out. I mean, that's the kind of a large value add.
Investors, I think they do always know when to get in and to get out after the fact.
No, but there's one thing I want to add on this, especially on the private side versus opening up of BTC and the rest, is making the benchmark a lot higher compared to what we've seen in traditional markets. So typically if you're looking at performance of a long only in the equity side, performance, if they're averaging, low double digits to mid double digits, it would be already exceptional. But when you're looking at the VC best returns, it's multiple of that returns. When you're looking in crypto and you're looking at the performance of liquid assets, including Bitcoin to start with, or some of the others like Solana and the rest, you have psychologically the impression that on a liquid, fully autonomous, you can make 2x, 3x, 4x. While on the VC side, you have to lock up your assets for 3, 4, 5, 6, 7 years, and you have the perception that within that time frame, the world can completely change, can completely collapse. So the benchmark of return has completely changed, but the perception for risk hasn't adjusted as fast. So I think it's going to be interesting to see how this adjusts over time when you get also more stability, I'd say, on the main assets, and then also more knowledge and institutional investors coming into the space.
Yeah, I think thinking about talking from a long-only fund point of view, and everybody kind of have Bitcoin as a benchmark and should be probably right, but really when we compare ourselves to Bitcoin, this is kind of comparing NVIDIA to S&P, right? I mean, if you obviously, and you mentioned this, Jorge, you know that NVIDIA performed much better than everybody else, but obviously after the fact. Think that from our point of view, what we try to offer is that diversification, right, in different stages. Bitcoin is a finished product, and then you have other products, right? You go from Ethereum, Solana, right, layer 1, layer 2, layer 3, right? So basically that kind of portfolio construction, what it gives you is two things. It gives you risk mitigation, and it gives you optionality, right, which is one of the most important things for us, because, and David mentioned it before, the investment horizon that you have in these kind of things can be 1 year, 2 years, it's 3 years that everybody else, every other investments, right? And so these protocols, they're not going to perform this year. They're going to perform probably next year. A lot of things need to happen for them to do well, and that's what we track. We track the teams, we track the roadmap, we track how they're performing versus their benchmark themselves.
Great. And David, when I see Web3 venture capital investment, and I look at traditional venture capital investment, I see just so many things that are better in the model fundamentally than what you have in traditional VC. What are, in your opinion, some of the things that make, if you want to go, because at the end of the day, if you go into traditional VC investing, you're going full risk on, right? Anyway, so why, while you're at it, do it in Web3 rather than Web2?
So I think the management of risk is the same, if not higher on any emerging technology. The part that differs the most to me in crypto compared to traditional VC investing is the fact that capital market expertise comes into play a lot faster than for traditional VCs. So traditional VCs, early stage invest, inception to 1-2 years afterwards, wait 6 to 8 years. 90% goes to zero, 10% manage to go to IPO, gets acquired. But by that moment in time, you have already one investment bank or a couple of investment banks taking care of the IPO, of the listing, and then of you selling. And the market's already mature, the business is already generating cash flows, so there is no requirements from the VC to be an expert in capital markets. When you think about crypto, as I said, after 2-3 years, your asset and the company you're backing, the founder that you're backing, is already making some paper profit, and you have to handle it because you're locked for the foreseeable future for 1 year, 2 years, 3 years, 5 years. And if you cannot handle that risk well, you end up in a situation where you've seen the highs, where you've made 50x, to the lows where your investment is worth nothing. So it's all about management of risk in a capital market fashion. And as I said, your action will have a massive impact because sometimes VC funds invest to hold 10% of the supply, and if the company is worth 3-5 billion, and you end up in a position where you can sell that 10%, the impact on the market price will be absolutely, devastating. So that's why, I think like that's the part that needs to be a bit more incorporated into the mind of VCs. But that being said, I'm finished there. Being too capital market oriented means that you're going to be opportunistic, which means that if you make 5x within 6 months, then you sell OTC, and you're going to miss out potentially the home run where you could have made 50x based on the fundamentals.
Thank you. I think we're not yet at time, but almost at time, and I'm running a bit short on my plane. So unless there's anything else you guys want to add, any closing remarks maybe from any of you guys. Otherwise, we can maybe cut it short by 3 minutes, and you guys will need to bear everyone laughing outside and you sitting here with us. Thank you very much for you, and especially to all of you guys for being here. It's been a pleasure to hear from all of these experts, and see you next time.
Thank you so much. That was great. And